Hello traders, Gary Wagner here, just about 11:10 in Honolulu, 4:10 in New York. It is Thursday, second day of March 2017, and this is the Daily Report for Gold and Silver. Off of the lows, but still dramatically lower pricing are the characteristics of today's precious metals markets, with both gold and silver selling off sharply. Gold futures basis April contract is currently down about $14.50, trading at $1235.60. The low of the day, $1231.10, with a high of $1250.80. We'll talk about that low and current support levels in a moment. As far as silver goes, also under pressure today. That market was trading off dramatically, down almost 4% on the day, a 70-cent decline at $17.79. That off of a low of $17.70 and a high of $18.48. Today's decline is dramatic. It is a sharp decline, a decline of about $15, currently at $12.35. And the question that we need to ask ourselves, is today's decline the totality of us factoring in a rate hike this month in March, or is it just the beginning of that? In other words, do we see any major chart damage? And the best way to look at that, of course, is going to be on a technical basis. The short answer is no, but I will spend a couple of moments and show you how I came to that conclusion. First chart that I do want to look at on today's show is a very, very short-term chart, 30 minutes in length. We can see the basic decline, this being 1242. Of course, March 2nd starts here. This would be the evening. And so during the evening, it was trading a couple of dollars lower. As you can see, it traded to a low of about $12.36, $12.35, popped back up to 42, and then declined to these lows at around $12.31. Now, from there, we did have a period of time, roughly 2 hours of time in which it formed a base and then began to trade off of the lows of the day, currently, as I said, about $12.35, which really offers us the potential of adding to our position, because if you recall, when we initiated our long position, and we are still long at $12.50, we reserved part of our capital to buy on a dip. This certainly meets that criteria. We've got the dip. I just want to see if there's any stability in the market. If we do see stability, without a question of a doubt, this is the point we will add to our position. So traders, as I said, in terms of our technical studies, I am not showing any major long-term damage or chart damage when we look at the recent price action. Now, I'm basing that on a pair of Fibonacci retracements and the fact that we have a critical harmonics at roughly the 1230, 1232 area. That would be this line right here. Now, our first retracement starts at the beginning of this big rally, which is the end of December, beginning of January. Market trades at 1120 and then tops out at about 1265. The second of these two retracements is following this first leg of the rally and subsequent retracement. We've added a fib retracement, which accounts for the rally from 1180 up to 1264. Now, when we do that, here is what's interesting. You'll notice we get a fib harmonics. Our harmonics is when we're using two different fib retracement time sequences, meaning we're starting from different points that come together, so to speak, at the same price point, and that's the harmonic. So we have a 38% retracement and a 23% retracement. The 23% retracement is of this larger move here, the larger of the two sequences. The 38 is of the shorter of the two. And the fact that they line up pretty precisely really indicates the strength of that overall move. Now, as I said, just behind it, we have a 50% retracement and another harmonics at roughly 1210. And so my sense is that as long as we're going to stay in this area, we should be okay. On a technical basis, we also have some strong technical support potential at about 1220, and that of course is really based upon these two series of tops here, which is the conclusion of the first leg of the rally. So based on that, we're trading at 1235. If we see any kind of solid support coming into the market and any kind of a bounce, this is the point that we want to add to our current position. Of course, a break below that, and that will put us in a holding pattern to either decide do we want to liquidate and limit our losses, or let our basic stop stand as it will, because I believe it's in a solid place. Because if we have this break below this particular price point, this being 1220, our stop being below 1216, it changes our models and the scenario in its entirety. So for the meantime, my recommendation is to maintain our current long position, maintain our stop, and look to add to that position should we see any kind of support over the trading day today into tomorrow. In other markets that we follow, it was a down day pretty much across the board, except for maybe the US dollar. Dow Jones Industrial Average, after reaching a milestone yesterday, trading up about 300 points, has given back roughly a third of that, trading about 0.5% lower, giving up 112 points at 21,002. So it has remained above 21,000, but we had a pretty dramatic sell-off on the day. When we look at the Standard & Poor's, that also traded to a new contract high, off 0.5% at 2382. And then lastly, the NASDAQ itself, that was trading sharply lower, off 0.7% at 5862. Now, noteworthy was dollar strength. Recent statements made by the Fed in regards to a potential interest rate hike at this FOMC meeting has really sparked a renewed vitality in the dollar moving up about 0.33%, now trading at 102.14. No doubt, after yesterday's record-setting day in the equities markets, the fact that we have got some backfill, that we've got profit taking, that doesn't concern me that much. But if you recall, over the last couple of days, actually the last couple of weeks, we've been speaking about the development of a pattern called a bearish three gaps. And what it is simply a series of bullish candles that have slight gaps in between them. And then once we hit this third gap, that typically is what's called an exhaustion pattern. It's run out of steam, and it predicts and predicates lower pricing based upon that pattern group. Now, we certainly have seen it come down from these highs today. When we convert our daily into our weekly into a daily chart, what we do get is a dark cloud cover. That's the single candlestick type that we're looking at. We would need confirmation, which would mean we would get follow through selling tomorrow. And if in fact that occurs, I would absolutely look for at least this gap to fill between this close here and this open here. And traders, of course, the big news, without a question of a doubt, has to be the US dollar. We can see that over this week, we've had extreme dollar strength, taking us back above 102. I am still showing resistance just below 104. It is based upon these previous tops right here. And I'm also showing a resistance, and I'm also showing major support at 99. We're about midway through that range, but I believe that we could see the dollar gain a little bit more strength before moving back into a mode of trading to lower pricing. So traders, as we spoke about in our opening comments, as well as our chart studies today, there's absolutely no doubt this sell-off today was dramatic. It was a sharp sell-off, resulting in a $14 drawdown to the price of gold, now trading at $12.35. However, we are also showing strategic support levels at $12.30. That is a 23% retracement, and then below that at $12.10. As long as we're holding above the 23% retracement, this might be a point to add to our current long position rather than liquidate at a loss. Our stops still remain below 12.16, and as of now, we are safe. But the question is whether or not today's action has factored in that interest rate hike, or if there's more to come. That can only be determined over the next couple of days. And realize the FOMC meeting this month doesn't start till about mid-March. So there's still plenty of time to react to that. But this could be the beginning of factoring in a rate hike, or it could be the totality of that. And that's really what we want to determine. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.